Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. The US dollar shows no sign of slowing down, with the dollar index hitting a new cycle high yesterday, fueled by elevated yields. Interestingly, Fed Chicago President Austin Goolsbee hinted at a significant drop in interest rates ahead, a comment that contrasts with the current market moves. On the data side, the initial jobless claims came in lower, but continuing claims saw an uptick, suggesting mixed signals from the labor market. Geopolitically, tensions remain high as Ukraine accuses Russia of striking it with ICBMs. Good morning, JK. It's the last trading day of the week and possibly a chance for, is there a possible chance for some relief for dollar bears? How are you interpreting these market narratives?
Good morning, Swaraj. Yes, for the dollar, at least if you look at the trend, it's been quite strong. And we are every alternate day we are making new highs. And yes, the only saving grace, or rather some comforting thought, could be that we are close to the October 23 low of 1.044448 for the euro, or you can say 107.35 high in the dollar index. And even we are at some good technical point also where it can hold for some time. But otherwise, if you look around, there's nothing that actually is supporting the euro from a fundamental point of view. The eurozone, economic problems, the political issues, then geopolitics, which has actually now put them in even a worse position because of the escalation of the war and possible supply chain impact once again. All these things. So I think euro has very little relief on the horizon unless market sees some change in any of these factors, or you see some value buying from a medium-term players at the good chart levels. I'm sure euro is not happy about the weakness in the euro because it's once again going to increase their inflation levels. So that's something which can see an support also, because you see even Chinese authorities are resisting Chinese yuan from going too low as well. Yes, otherwise market is dominated by the war news because after firing of missiles by Ukraine into the Russian soil, we have seen even Russia reportedly, retorting with their intercontinental ballistic missiles, about which there are differing opinions, but definitely the scale of the reaction has been quite high, and that's keeping everyone on the edge. So while there has been a spate of economic news yesterday, all that is being taken in the stride, and every reaction is more towards how the war is evolving, how the war situation is going to be going forward, because the much touted expectation of Mr. Trump, who is re-elected as president, could end the war, is now actually pushed back, and we are faced with a real escalation in the battle. And of course, it started to impact on the oil price also. That means you will have a slightly higher inflation going forward, depending on how high the oil goes. So it's an evolving situation. In the meantime, we have had some data, which of course would have been normally market influencer. But in any case, let's look at them. The consumer confidence in euro area decreased again by 1.2%, 1.2 points actually in November 2024, falling below its long-term average and worse than the market expectations. So this is adding to the ooze of eurozone. Bank of Japan Governor Ueda said that the central bank would be seriously taking into account the foreign exchange rate moves in compelling their economic and price forecast. So dollar yen has moved back towards 154 from a high of 156 plus that we had seen a couple of days ago. The leading economic indicators for the US declined once again by 0.4 in October, and this was against 0.3% decline in September. And the leading economic index provides an early indication of significant turning points in the business cycle and where the economy is heading in the near term. As you mentioned, the jobless claims, in fact, came on a mixed note. The fresh claims, in other words, the people who are freshly out of jobs are much lower. Fresh, so that has come down by 6,000 to 2,13,000, quite a low number for several months. But that gives, while that gives a good picture, the continuing claims coming much higher at 1.908 million is a cause of worry. That means the people who lost jobs earlier have not been able to find jobs once again. So that continued claims are increasing, which is also giving some sort of a negative pitch on the labor market. Japan inflation number was also announced today. Core inflation was core as well as the headline was higher than expected, though slightly below previous month, but the month on month there was a surprise that came at 0.4% positive versus minus 0.3 last month. So overall, markets have had little reaction to these numbers, but yes, even the US officials start, stream of US officials talking about how the inflation is going to play out, how the Fed should be going, and quite a differing views we have been getting. Some saying we should take it gradually, some saying that inflation will fall for much more. So market is really not not trying to conclude anything from these things, but the market discounting shows that we are at about 55% probability of 0.25% cut from Fed. So as I said, the dollar continues to be strong, and strength is more apparent in euro than in any other currency. If you look at some of the commodity currencies, they are doing better. The Canadian dollar, after the higher inflation that we saw, and the Australian dollar also has been quite firm. This has also happened after China and Australia relations are seen to be improving. China agreeing to import more commodities from Australia. So I think but for the war factor, probably dollar would not have been so strong. Although one would also think that the inflation is something, the expected higher inflation in Trump's policy is something the market will be trying to discount going forward. Now, the biggest mover, I would say, on a surprising side was the rupee, because we had a move of as much as 8 paisa yesterday in the rupee, and while in an overall currency market scenario, 8 paisa looks very 0.1% and does not look big at all. But in the context of how the rupee market has been behaving, how it has been controlled by RBI, for several months, it looks big, but it also indicates how big the demand was yesterday, as the stock market took a big hit after the news about some corporate conglomerate negative news that was not taken well by the market, and therefore we had seen over 5,000 crores of FD equivalent of FDI outflows yesterday, keeping the dollar well bid. Yes, not that the nationalist banks moved away, but actually they have moved higher on their selling level. It will be interesting to see whether they let the 84.50 mark decisively break, because that's also a good resistance point. And even if they do, I still don't see a panic move in the INR. Possibly, if we see more selling from FIs and more outflows, we could gradually move towards 84.60. But even assuming the FI selling is not as much, but the geopolitical situation is going to keep the Indian markets on the edge. So I don't see a major recovery either for the INR or for the stock market. So most people would be thinking that it is, thank God it's Friday, but then that can be dicey as well, because 2 days is a long period when geopolitical situation can take any big turn as well. So wish you all the best. Thank you.
Thank you, JK, and very well covered on the data front, because that's definitely taken a back seat. But
very important indicators coming about with the eurozone consumer confidence dropping, mixed picture from the US labor market, Japanese inflation being higher. So all of this, I think, when geopolitics would not have been in focus, these would have been definitely market movers. And just highlighting one small point was that the rate cut probability in December by the Fed now stands at 55% for a 25 basis point rate cut. So that's something to keep in mind. That has been, I think, steadily dropping because earlier it was pricing quite a bit for a rate cut in December. Now, for rupee, we hit new all-time lows and we moved by 8 paisa yesterday. And as JK mentioned, the stock markets also took a big hit after the negative news by a large Indian conglomerate. Now, the all eyes will be on 84.50. Whether this is something that would be broken is something markets would be closely watching. That's it from us today. Have a very good weekend. We'll catch you all on Monday with the fresh round of market developments and updates. Thanks for listening.